All right, in this lesson, we're going to show you how we prepare the balance sheet. Now, this is actually the third financial statement that we would prepare after we prepared the trial balance, which we learned in the last lesson. But because we don't have any revenues or expenses, and we don't really have to worry about retained earnings yet, we're going to go straight to the balance sheet. So once you have your trial balance and we don't have any revenues, expenses, or retained earnings, we can go straight to the balance sheet and prepare the balance sheet, which I'm going to show you at the end of this lesson. So the first thing that we're going to do is kind of help you understand what goes into the balance sheet, how we organize the balance sheet, and then we'll get to that example at the very end. So let's get started here with the definition of a balance sheet. So the definition of a balance sheet is that the balance sheet includes all of the company's accounts for assets, liabilities, and equity. That's it. So you learned that we have 6 components. We have assets, liabilities, equities. We also have revenues, dividends, and expenses. In this statement here, we retract the expenses, the revenue, and the dividends, because at the end of the day, those would have already been closed out to the retained earnings, and that retained earnings would have flown to here. So all we care about here is the assets, liabilities, and owner's equity. Now, the very first step is obviously to prepare that trial balance, because the trial balance is going to have all of your accounts, all of your amounts. And the balance sheet is going to have all of your accounts that are asset, liabilities, or equity, and all of the balances at that point in time. So that's the key here, is to doing that first, then doing this. Now, once you've completed the trial balance, we're going to pull all the assets, liabilities, and equity from the trial balance and order them in a specific way. So if you've done your trial balance correctly, it's just a copy job at this point. We're just copying the account names and the balances onto the balance sheet. Now, other than individual component separation, so we are going to separate it by assets, liabilities, and equity. We're also going to separate it by what we call current and non-current. So this really specifically deals with assets and liabilities, not necessarily equity, but we're going to look at what accounts are current and what accounts are non-current and organize them that way, and then by liquidity. So let's talk about what these current and non-current items mean. So we've got current. Current represents any asset or liability that is expected to be used up or paid off within 1 year or the operating cycle of the company, whichever is longer. So let me give you an example of what's current. So if I were to buy a box of supplies, would we expect that supplies to last us for less than 1 year or more than 1 year? And I know some of you devil advocates are saying, well, what about if I buy like 1 million boxes of supplies? Let's keep it reasonable here. If we bought a box of supplies here, would it last for more than 1 year or less than 1 year? Well, it probably would last for less than 1 year. Therefore, supplies would be a current account. Why? Because we don't have an expectation that those supplies would last us longer than 1 year. What about equipment? Well, equipment, we've already established, lasts a company for longer than 1 year. So therefore, it can't be current, because we would expect an asset like a piece of equipment to last us 5 or 6 years. So that would not be current. That would be something else. So when we look at our assets, we see what are assets that we use up or we deal with within 1 year or the operating cycle, whichever is longer. Now let's talk about that second part of the definition here, the operating cycle of the company, whichever is longer. So for most companies, their current cycle is 1 year. Okay, because their current cycle is really less than 1 year, so we use the longer of 1 year or the operating cycle. So most companies will have 1 year. There are some companies that have a longer operating cycle. What do we mean? It takes them longer to go from cash to, let's say, buying inventory to then selling that inventory and coming back to cash. Those companies are like construction companies. Construction companies might take 2 or 3 years to build a building, so their operating cycle is going to be much longer than, let's say, a retail store that buys goods and then sells them on the floor. normally those are sold within 1 year of the operating cycle of the company. Whereas someone like a construction company, it's going to take them more than 1 year. So for a construction company, what's current to them is anything that's longer than 1 year, but within that operating cycle. So for instance, like Boeing's operating cycle is usually about 18 to 24 months. So their operating cycle is not 1 year, it's actually 18 to 24 months. So thinking about that there, most companies are within 1 year. So you can almost assume that most companies are 1 year. There are a few companies that, are longer than 1 year just because of the nature of what they're doing. Okay, so that's what current means. Now, the opposite of that is the non-current. Non-current represents any assets or liabilities that are expected to be used up or paid off longer than 1 year or the operating cycle, whichever is longer. So these are basically any asset that doesn't conform to the definition of current. So it's longer than 1 year or it's longer than the operating cycle. Okay. So that equipment would be a non-current asset, not a current asset. The supplies would be a current asset, not a non-current asset. A building, we would expect the building to last for longer than 1 year. So that would be non-current, not current. Cash, we would expect that a company use cash within 1 year. So that would be current. Okay, so that's the category section that we want to pay attention to. Is it current or non-current? Now, after we figured out what type of accounts we were using, whether they are current or non-current, we can then organize them by liquidity. Most liquid to cash goes first, and then from there, we go to least liquid. So obviously, current assets would go first, and then we would organize them from most liquid to least liquid. And then after that, we would have non-current asset. And again, same thing there. Even though these are non-current, meaning that they're not going to be used up within 1 year or the operating cycle, whichever is longer, we still organize them to most liquid to least liquid. So, equipment would be probably more liquid than maybe a building, which would then be more liquid than maybe land. Okay, so understanding that we're still going to organize it by liquidity. Now, when we do this, this gives us something called a classified balance sheet. Now, we could throw in asset, liabilities, and equities into a form like I'm going to show you at the end of this and call it done dead. That would technically be a balance sheet. But in order to have a classified balance sheet, we've classified all the assets and liabilities as current and non-current, and we've organized them by liquidity, most liquid to least liquid. So that's what we would call a classified balance sheet. So let's look at an example here. So I have a trial balance, and it's usually prepared in a format that the balance sheet's already prepared. So all we're doing is just moving it from here to a balance sheet financial statement. Now, you might have some dividends and revenues and expenses, but we'll explain what we're going to do with that later. In this instance, we have none of that. So that's why we can prepare the balance sheet, because we don't have to worry about revenues, expenses, or dividends. Now, what I would do is if we're going to attack this balance sheet is I would go through each account and ask myself, is it an asset, liabilities, owner's equity, revenues, dividends, or expenses? That's going to help you, because once you've categorized all of your accounts, then from there, you're just going to pull over your assets, liabilities, and owner's equity. Now, this is easy because they're all an asset, liabilities, and equity, but let's go through that practice so that when you have a longer trial balance, you can understand, what's going on and know how to solve it. So if we look at this, we've got cash. So cash is an asset. I'll put an A here. Supplies is an asset. Equipment is an asset. A sign is an asset. A logo is an asset. How do we know all of those are assets? Remember that asset provides benefit to the organization, typically for it just provides benefit for an organization or a future benefit for the organization. All of these provide a future benefit for the organization. A logo, obviously, if you have a really good logo and people attach to it, now you have an attachment to a logo, and every time you see it, every time a customer sees it, they instantly think of you, and that might trigger a sale because of that. A sign, you need to have a sign outside your store to identify yourself. So that's also a benefit, a long-term benefit Cash is obviously a benefit. Supplies is a benefit. Equipment is a benefit. So all of these are benefits that, or they are things that provide a benefit to the organization over time. All right, accounts payable. So payable means that we owe, so that's a liability. Notes payable means that we owe, that's a liability. And then common stock is an equity account. So we'll put owner OC because we don't want to confuse it with expense. So owner's capital there. So we've got assets, liabilities, and owner's capital. We don't have any expenses, revenue, and dividends. So we've categorized this. Now all we're going to do is we're going to transfer all of our assets, liabilities, and owner's capital to the balance sheet. Now, I don't have this on the next screen slide that you're going to see. So you might want to take a picture of it or screenshot it before we head over there, because we're just going to give you the balance sheet. I have it in front of me on a piece of paper here, but you won't have it on your screen because there's just not enough space. So you might want to screenshot this, and I'll give you a second to do that now. All right, let's go to the balance sheet here. So here's the balance sheet. Now I've kind of made it a little bit easier. I've given you all the accounts here. All we're going to do is the amount. So if you notice here, we've got the who, the what, and the when at the very top. Walnut Creek Inc. Balance sheet as of April 30th, 20x1. So remember, a balance sheet is a point in time rather than a period in time. Therefore, we're going to put a date at the top rather than the period of or as of some period of time. All right, so notice here we've got our assets here, we've got our liabilities and stockholders' equity here, and then we've separated from current and non-current. Now, if you notice, I didn't necessarily put non-current titling here. I just put current, and then I have non-current at the very bottom, and that's fine as well. Okay, so let's take a look here. Let's look at what balances are we moving over? We're moving over all the assets. So the first asset that we had on the last slide there was cash. Cash in the amount of $40,425. So I'm just going to put $40,425 right next to cash. It's just a copy job. There is no calculations here until we get to the total amounts. All right, moving on to the next one, we've got supplies. Supplies on our trial balance was $825. So I'm going to transfer over $825 to our supplies. Now we see total current assets. So what you're going to see on a balance sheet often is, in order to really classify it properly, is we summarize our current assets. Why? Because that's actually going to help us calculate some ratio analysis later on, because that is truly an important number at the end of the day. So that's why you're seeing it calculated here. So if I take $40,425 and I add $825, you're going to get $41,250. So that's how much current assets we have. Moving on, equipment. On our trial balance, our equipment was $11,850. So we're going to put $11,850 there. And then our sign was $6,540. So I'll put $6,540 next to sign. And our logo costs us $650. That's again from our trial balance. So we're moving everything from the trial balance to the balance sheet. All right, so now it's time to add up all the assets. Now, this is where it gets a little tricky, because remember, you did summarize all your current assets, which means I'm not going to summarize all these numbers here. I'm only going to add up these numbers here. So do not add these. Okay, because if you add up the $40,425 and the $825, you're going to duplicate your numbers. Okay, and that's going to give us an inflated total asset that we shouldn't have. Okay, so if I add up those four numbers, the $41,250, $11,850, $6,540, and $650, we should get $60,290. $60,290. So that is the total assets for this balance sheet. All right, moving on, we got to go to the current liabilities. So again, all we're doing here is we are going from the trial balance here and copying these numbers and the account names to the trial to the balance sheet. So if you notice here, our accounts payable is $10,290. So we're going to move $10,290 to our balance sheet. That's the only current liabilities we have because a notes payable typically is a long-term type of thing. So we're going to add up all of our current liabilities. So it's going to be $10,290. And then we got our long-term liabilities. In this case, notes payable of $10,000. And notice here, we don't actually have a total liabilities. That is fine. Oftentimes you won't see that. That's okay. We'll just keep on going. At the very end, we want to make sure that our total liabilities and stockholders' equity actually equals our total assets. So moving on to common stock. Common stock I had at $40,000 even. And so once we've done that, we'll add up all of our liabilities and stockholders' equity. Same issue as before. We don't want to double count our current liabilities. So we're only going to add up these 3 numbers instead of the 4 numbers because we totaled. So if we add up those, we should get $60,290. Now, did we cover all of our trial balance, asset, liabilities, and equity? So if I go back, we hit cash, we hit supplies, we hit equipment, we hit signs, we hit logo, we hit accounts payable, we hit notes payable, and we just did common stock. So I've covered all of our assets, liabilities, and owner's capital. So I've got everything that I need on this balance sheet. Now, how do I know that I did it right? Well, we don't know if we did it 100% right because we could have mixed up some numbers and still got the same answer. But generally speaking, if my total liabilities and stockholders' equity equals my total asset, then the assumption is that I've done this correctly. So that's kind of how we know we've done this correctly at the end of the day. Those two match. And again, the reason why I say we're not 100% sure is maybe we took $10 from cash and we accidentally put that into supplies, but it still balances out to $60,290. That could happen, and that does happen. But for the most part, we can be like 90% assured that we've done it right if those two balance. If they're not balanced, you got to figure out what's wrong. And usually you have to go back to the trial balance to figure out, did you transpose a number wrong? Did you switch 2 numbers when you were transposing them over? Usually that's what happens there. So that's a look at the balance sheet and showing you how we actually prepare it. This was an easy one, but obviously if you get the trial balance down, it's just a copy job from the trial balance to the balance sheet. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it's Patrick. Before you skip ahead to the next section, just wanted to come on here and tell you to not forget to like this video and maybe share this video with someone that you know that would get a lot out of this lesson. Maybe a classmate that you know. This would be a great way to introduce them to this channel. So share this video with them, maybe your mom or your dad, someone, so that they know that you're really learning accounting topics here on YouTube and you're not just playing cat videos over and over again. Now, if you want to help us grow this channel, what would be great is if you press the subscribe button and maybe even turn on the notification bell if you want to get alerted the next time we upload a video to this channel. And put in the comment section below, what did you eat last night? It would be so weird for people to come and look at the comments, but what did you eat last night? I might throw in a comment after you if you put that in the comment section below. So do that now. What did you eat last night? All right, so enough of the fun stuff. Hope you enjoyed this lesson, and we'll see you in the next video.